Risk and reward management are at the heart of any investment. Money goes into ideas and efforts that have a chance of paying it back with a little bit of profit at the end. If risk is completely removed, anyone will make decisions and try things that they might not have otherwise. When the risk is spread out to people that they don't know or necessarily care about, disaster is usually pending. That's pretty much what has happened to our economy. Socialized risk with privatized profit. Supply-side theory, where investment money is made as cheap as possible, is all about reducing the risk to investors. Whenever money can be borrowed cheaply, it will find its way into investments that otherwise would be considered too expensive to be worthy of the money. This kind of policy is supposed to pay for itself by fueling a high level of growth that will bring in more revenue later. This is what the Laffer curve is all about, named for economist Arthur Laffer, which has been extensively analyzed when and where cuts in marginal rates to investors have worked. When taxes on investment get too high, it is entirely possible to stimulate growth through the economy as a whole by cutting rates, as Arthur Laffer has shown in his own blog. But there are two problems with this analysis. First is that it does not mean that always cutting taxes for investment will help fuel growth, and Laffer himself has acknowledged that. There's a time and a place for everything. The second problem is much deeper and shown by the times when Arthur Laffer has shown that his example has worked, the mid-1920s and the late 1990s, the start of massive credit bubbles that collapsed into depressions. This naturally lends itself to the other side of a cheap money policy, the part where deregulation of banking is always considered good. The creation of large banks makes money cheaper, encourages investment, and thereby increases the total risk taken on by the system. But when their failure becomes not an option, the risk is socialized by a bailout. That's what we saw in 2008. Supply-side policy is only one aspect of socialized risk, however. The Black-Scholes-Merton theory dealt with risk directly, at least by eliminating it. The concept is simple. Any investment can be insured by selling contracts that pay off as it fails, pushing the risk out to a larger market. This is what a credit default swap is all about, a kind of derivative, a financial instrument that pays off in some purely financial event. Set up a big investment properly, the theory goes, and you can be guaranteed risk-free return forever. Without getting into the impressive math that won a Nobel Prize and makes this other batty idea look smart, there is a major limit to the application of how this works. It assumes a stable liquid market that does not have a major disruption. As long as everything keeps on keeping on, it is possible to eliminate risk in a truly tranquil world. The application of this work met the supply-side movement in the late 1980s, and you can imagine how it works together. When money can be had for cheap and invested at no risk whatsoever, there's only one thing you can do: borrow as much as possible and leverage investments everywhere you can. That's how the global market for derivatives reached $516 trillion in July of 2007. That's not a mistake. $516 trillion, 10 years worth of production of the entire planet was sold as derivatives, financial contracts based on other financial events. It came down a little bit since then, but it's growing back up. And it's still close to 7 years of the total world product. The risk, of course, has not gone away. It became a socialized risk borne by the entire system and ultimately governments that have to protect those that are too big to fail. The massive credit bubble that created and defines this depression was created by leverage, or other people's money. OPM, the real opium of our time. That's what socialized risk is all about. It may not set well with some to call risk that is distributed through market forces a kind of socialized risk, but there's no better term for it. If the risk is not carried by the investor, it's shared socially by one mechanism or another. If there's a government policy pushing the concept at the front end, an applied bailout at the back end simply distorts the market. There are some who look at the system of socialized risk and demand that the rewards be socialized, either by nationalizing the banking system or at least regulating it as some kind of public utility. The other option is to understand how supply-side theory is indeed socialized risk and ditch the whole concept, at least dogmatically applied to every situation. Either by going with socializing the banks or ditching the supply-side theory, I'm good with it. The system we have now of socialized risk to privatized profit has shown itself to be a failure. And that's the real root of the credit bubble that gave us the depression that we find ourselves in right now.